morning. This is Caring in America. I'm Richard Wexler. This is the podcast for caregivers and care recipients. So, folks, the ones that have been listening to me for a long time, maybe some new folks, 20 years ago, I'm not doing this, minding my own business in the software industry, married later, 2 small kids, 4 parents between my wife and myself. We think they're doing great. We're wrong. We start getting phone calls in the summer of '05, starts us on a care journey, taking care of them for 14 more years. So about a year into that, realized I could barely spell the word care, started researching everything I could about aging and care, started educating across the country, are continuing that through our podcast, which you're listening to, which we started 2 years ago. And then in January of this year, we kicked off a plan to age. And we're actually going to be starting our national conversation on aging, really helping people understand these complexities of aging and care next month. The first conversation's at 1 p.m. Eastern on July 29th. So I want to introduce our special guest this morning. Her name is Karen Kaiser. She is a senior mortgage advisor and retirement mortgage specialist. She has 24 years of experience in the industry and is licensed in Idaho, California, Texas, and Florida. She's an avid educator. She teaches and advises, consults, and originates residential mortgage loans for all generations. These include purchases, refinances, retirement, reverse mortgages, fixed seconds, HELOC loans, construction, rehabilitation, and specialty loan programs. She holds a loan origination license through the nationwide mortgage licensing system, a real estate broker's license through the Department of Real Estate in California, and is a registered Social Security analyst and holds a designation as a real estate collaborative specialist in divorce. Are you here, ma'am?
Yes, I am, Richard.
How are you this morning?
I'm doing great. Thank you. Great to be here.
Well, thank you. I appreciate you being on the podcast this morning. So we want to talk about reverse mortgages. So I'm going to start with a really broad question to help our audience understand what is a reverse mortgage.
Well, I can tell you what it's not. It's not a scam. It's not a scam. It's not this fraudulent ghost or boogeyman way to lose your home. It's really quite simple. It's a residential mortgage loan, just like a forward product. When I say forward, we talk about traditional mortgages, like what most people are used to understanding, like a 30-year fixed. They know what that means. They know that they're going to make their principal and interest payment amortized over 30 years, and they're going to make that until they've paid off the loan or sold the house or refinanced it into another loan. Well, a reverse mortgage is exactly the same thing, only instead of going forward, paying it off, we pay it off in reverse, meaning we pay it off at the end of the time that you're done with the loan. So it's like, kind of look at it like you get a car from a friend and your friend says, don't worry about those payments. We'll just let them ride. When you feel you've got the money or you're done with the car or you're ready to sell it, it's time to pay it off. Just give me the check then. So a reverse operates very much the same way. It slowly accumulates mortgage interest, but there is no required principal and interest payment by the homeowner or borrower until the loan is terminated, meaning they could sell it, they could refinance it, they could buy another home using it. But other than that, they don't have an obligation of a principal and interest payment on the loan until the time the loan is terminated, when it's paid back.
This is really interesting, and folks have been listening to me for a while, and I talk about the thousands of people I've stood in front of educating. And Karen, for your edification, probably 15 years ago, I'm doing an event. I have a decent-sized audience in front of me. The subject of a reverse mortgage comes up. And this gentleman, who I'm guessing was probably 85, maybe even a tiny bit older at that time, stood up and started. I mean, do I know a lot about reverse mortgages? I think I know enough to be dangerous. Stood up and started challenging me about what a horrible product a reverse mortgage was. And I think you may have said this, how the bank was going to wind up taking your home, and it's not something that he wanted, and it's not something that he would tell his friends they should get. And I'm gently pushing back with this gentleman, and you can correct me if I'm wrong, and telling him that may have been the way products were a long time ago, but when I was talking to him about 15 years ago, it wasn't the way a reverse mortgage was then or now. Am I right or am I wrong?
Well, let's just say that this isn't the 1980s, and the what I would call the new reverse mortgage that we all have been using for about the last 10 years roughly is not the reverse mortgage of the 1980s. This isn't your grandma and grandpa's reverse mortgage. The concept, when they came up with it during the Reagan administration, very popular, very necessary. However, they didn't really investigate the necessities as time went on, what was going to be needed to improve the product, safeguard the product, make sure that people didn't lose their homes, that they understood the dynamics behind what they were trying to create. Moving fast forward, since then, there have been multiple laws put in place that safeguard the home buyers, the homeowners, the people that decide that a reverse mortgage works for their retirement plan. This is a retirement tool, 100% powerful retirement tool. But back then, there were missing pieces to the puzzle. So he was right and you were right. It really just depended on how it was created, when it was originated, but ever since, I would say the very latest in 2018 was one of the latest safeguards that were put in place. Now we have mandatory counseling. Now we have financial assessments, the protections for the non-borrowing spouse. There are protections for making sure market value is true and to accord, such as if it is a unique property that doesn't comp very easily as far as market value goes. Sometimes there's a request for a second appraisal. That's to the benefit of the borrower, making sure that the value that's being assessed and the equity that's being accessed is an appropriate amount for this particular borrower in their situation. So now the new reverse mortgage. This is a modern financial retirement tool that has safeguards in place, and it is a wonderful product. I have my mother-in-law in one. My parents have one. I hate to say this, but I'm not too far away from one myself. I actually meet the age requirements and an equity position, and it's absolutely in my retirement tool belt to get one. So no, they are wonderful products. They just had a bad start and didn't have the assurances and the safeguards in place that they do now.
Very interesting, and thank you for that. And folks, as I always say, what Karen's giving out here is some great information. Please pass this on to others around you as well. Karen, I've heard the term non-recourse. What does that mean?
This is non-recourse in and of itself, just the definition of it basically means there's no recourse if something adversely occurs. So as it pertains in the loan industry, we'll go back to a traditional 30-year fixed as an example. If you fail to make your mortgage payments, the lender has recourse, meaning they have the right, the entitlement, the option, and the course to take action by making sure you make those payments. And if people can't, and there's a deficiency or a default in those agreements that they made with that lender when they originated that loan, lender has a right to foreclose on the property. They have a right to take back that house. This is on a forward mortgage. People forget that there's an obligation on both a forward and a reverse. So in the reverse space, in a situation where, let's just say, mom and dad originated one of these and they've had it for 30 years and they never did anything to change it. They never refinanced it. They didn't pay it off. They let it run its course. And let's say we experience a market condition shift like occurred in 2007. We had the mortgage meltdown crisis. I was working at the time in the lending industry. And property values in California, Florida, Arizona, Nevada, which were the 4 hardest states hit during that time, flipped them upside down and backwards. Properties that were worth $1 million were worth 500,000 basically overnight. Within the matter of 6 months, we were in this huge real estate crisis and financial lending crisis. Well, if someone had a reverse mortgage during that time, when many did, and their property values, and when they got that a reverse loan, when they obtained it, they were right side up. Their loan balance was far less than what the market value was at the time. And then a wave of destruction hits. Now it's upside down. And now that borrower could be in a position, we're saying in 2008, where that happened, and that loan which they had was worth 500,000. Maybe that was the loan amount that they had taken out was 500,000. At the time they did it, the property was worth $1 million. Well, now it's worth 250,000. What if it went upside down and it was terrible? So let's say, for the sake of mathematics, they're upside down 250,000. And they decide it's time to terminate the loan. Maybe they're going to go into an independent living or a dependent living care situation. And they no longer need to live in their house. Part of the condition is that they do, and that's their primary residence. So it's time to terminate the loan. What happens to that $250,000? They're upside down because they can just sign over the property to the lender. There's no equity left, right? They owe 500. Property value's worth 250, so there's no equity. So they are going to give that property back to the lender. So what does the lender say when they're short 250,000? Well, the non-recourse position in this reverse mortgage, this is an aspect that's so powerful, prohibits the lender from seeking any additional recourse or financial compensation to make up that differential. So that means the borrower, the homeowner, who's 250,000 upside down, it means their heirs, their estate, nothing can be touched by the lender. The lender accepts the payoff of 250,000 and they write off the rest. The other 250,000, that's what the FHA insurance policy guarantees that lender not to worry about it. The default can occur and there is no recourse to the borrower, their estate, or their heirs. It is a wonderful protection mechanism for somebody that wants to have one of these long-term.
Wow, I didn't realize that 2 words meant all that. That's great information, folks. And the example that Karen was giving, again, please pass all this information on. So are there different types of reverse mortgages?
There are different types. I think that the 2 most common types that people would be familiar with, and they may not even be familiar with one of them. The most common is the HECM, the Home Equity Conversion Mortgage. That is the FHA insured product, requires borrower to be 62 years old or be married to someone that's 62 years old at the time that the loan is originated. And that FHA product, which is, in my opinion, one of the very best out there, allows you to also have a line of credit. These are different options that grows substantially. It grows at the same rate that the loan balance is growing at, plus another 0.5%. And that line of credit, we won't get into too deep into that. That's one of my favorite topics, is this line of credit growth feature that's within the HECM program. A HECM can also be a fixed rate or an adjustable rate mortgage. And a lot of people freak out when they understand that the best product is the HECM ARM, adjustable rate mortgage. And there's a reason for that. Because under the ARM product, you have the option of this line of credit. And there's a lot of great features associated with the use of that line of credit. It's like having yourself a non-income taxable account that you can draw money on, grow money to, use money, put it back in, use it again. This is a mortgage of options that you do not have in any type of a forward space. The second type is a proprietary product. And when I say proprietary, it's because it's not a government insured product like the HECM. It means it's proprietary to the lender investor who is standing behind the loan. Most of these are considered, quote, jumbo reverse. That's how a lot of people may have heard the term if they've looked into it. And the reason that they do that is to allow for a reverse mortgage to occur for a homeowner whose home value happens to exceed whatever that current year FHA maximum amount is. Now in 2025, that HECM will allow a property value to exist of 1.209,750,000. So if you, Richard, if your home is 1.209,750 in value, the HECM might be a good product for you. But what happens if you own a $4 million house? Well, if you own a $4 million house and you would like to tap in, have access or availability to use the majority of what you are entitled to use of that value, then that 1.209 is not going to help you as much if your property value is worth $4 million. So at that point, a proprietary product would be the solution for that. Now, two differentials. There is not an insurance policy, an FHA insurance policy. We call it an upfront funding fee. They do not exist in the proprietary products. That is made up, the difference is really made up or absorbed in the interest rate. The proprietary products have higher interest rates than the FHA HECM products, and that's because the lender is absorbing that insurance position, that non-recourse insurance position in the rate.
Wow, very, very, very interesting. So you mentioned the age of 62. How do you qualify? Who can get a reverse mortgage?
So, and just to go back, the proprietary actually allows for age, in most cases, age 55. And also, I'll just say one more thing about proprietary is it's very state specific, whether it can be a fixed rate, an adjustable rate mortgage, if the borrowers can be 55, such as in the state of Texas. A proprietary product in the state of Texas, you have to be 62. So proprietaries across the board typically start at age 55 if the state allows that. So let's just say you're age 55 and you want to have a mortgage, a reverse mortgage. You've got a lot of equity in your home. Maybe you own it outright. You have no mortgage payment whatsoever, but you would like the opportunity to tap into that cash equity. Whether you choose to use it or not, you just want the ability to be able to access it. Then if you're age 55, you can look into this. If you're age 62, you qualify for the HECM, the home equity conversion mortgage, the FHA product. And or if you're married to somebody age 62. So what if you're 62 and your spouse is 58? It's fine. You could still do that. What if you're 60 years old and you're not married to anybody? Well, I guess you could go on seniors or tinder.com and find yourself a spouse that was age 62, and then you could take advantage of that product. But yes, but you have to own your own home. You have to have it as your principal residence. So you can own multiple pieces of real estate with this, but you can only take out a reverse mortgage on your primary residence.
Interesting.
And you must live in the property at least 6 months out of the year, unless you're traveling abroad. But it has to be your primary residence, and you do have to go back to it. You can't just leave it. There you go.
Again, a lot of great information. So the key benefits for a reverse mortgage, and are there some ideal candidates? Do you have any stories of maybe people you've worked with? And you can leave their names out, obviously, but any stories?
Sure. The benefits are basically they're exhaustive. I mean, they can go on and on and on as far as what are the key benefits. So many of them. You could bridge your Social Security or retirement income. Maybe you're in a position where you want to hold off on Social Security, let it build up that extra 8% for the next 2 or 3 years and take it at 70. Well, if you need a couple extra dollars to make up that differential, take it out income tax free and draw off of your equity position within the reverse. And then when you're 70 and you have what you need, you don't need to draw on it any longer. People use it as a bridge for down market investment portfolios. Maybe you're drawing excessively down on your retirement portfolio and you want to mitigate that risk. You want to give it time to bounce back when the market improves. Why not take it income tax free out of your reverse mortgage? Just long enough to use it, back into it when you need it. Market returns, you go back to doing your other withdrawals. So it's called strategic withdrawals. Okay. But let's talk about the stories. I can give you 3 really good ones. One of them I'll talk to you about. It's actually one of them is my mother-in-law. My mother-in-law is currently almost 89 years old. She and my father-in-law got their first one in 1997. I did not originate that at the time. They got it through Wells Fargo. And this was before a lot of the protection mechanisms were in place. It still served them quite well. They were sued by a local mobile home park because a fire had ensued on the 40 acres of ranch land property that they owned. And he was a retired Border Patrol agent. And they didn't have the funds from which to pay for these houses that were burned to the ground, but a transient had been on their property and started the fire. They obtained a reverse mortgage. They owned their house outright. They were able to pay for that fire damage that had occurred. And then 2 years later, their roof needed to be replaced. Yeah, they used the money to replace their roof. A year after that, their well went dry. It's very expensive to drill wells in Southern California. And were already protected. They already had what was necessary. But what I want to do with this is go a little further. When he passed away in 2006, she kept this reverse mortgage until 2015. So from 1997 to 2015, she had the same reverse mortgage. Didn't make a payment on the principal and interest on it. Lender held it all that time. When she sold it at a profit. Yes, profit.
Wow.
After all those years, bought another house, owned that house for 4 years with a reverse mortgage, sold that house, and we moved her to Caldwell 6 years ago, made enough money on the sale of the second house to pay for this house, put it in a reverse mortgage. And because she chose not to use all cash, which is a really silly thing to do, she was able to leverage with the reverse, put the money in the bank. She has a nice savings account in there, and she's still sitting on over $300,000 of equity in the house. So it could be used multiple times, used with making money, continue to leverage money. And then I'll go to another one. Divorced borrower, age 65, 66. I think at the time she actually was divorced. She had been a stay-at-home mom, did not have regular income, and needed to have a few things satisfied for her. Her financial advisor reached out to me. She needed income. She did not want to have a mortgage payment and wanted to be able to travel. So what we did is we arranged to use the reverse mortgage to purchase her a fourplex. Yep, a 4-unit project. And then she lives in the largest.
Go ahead.
She lives in the largest of the 4 units, pays a property manager to manage the other 3, travels extensively, at least 6 months out of the year she's gone, and she makes income from the rental of the other 3 every single month, and she pays into her line of credit with the income that comes in. So what happens is she's paying down the loan balance every time her line of credit gets added to. So when she receives that income every month, it goes into her line of credit. The line of credit grows. Right now, I think for her, it's around 6.5%. It's growing every month. And then she can tap in and use it as she will. But she is making money, earning income, has a great property that's building her equity, traveling, and subsidizing her income monthly. So it satisfied multiple options for her, and that money's coming out for her income tax free when she needs it. I'll give you a third and last little story. Very affluent clients that live in Los Angeles. Their financial advisor reached out. We had a discussion about what to do, and they are young, 62 and 63, self-employed borrowers, owned a big business, have 3 children that do not live in their house, have no intention of ever selling the home they live in LA, and they want to sell their business, and we're not ready yet to draw on Social Security. They're too young. And in addition, they didn't want to be drawing on any type of investment portfolio just yet. And we're looking to mitigate taxation across the board. They had a $4 million house. We used a proprietary product for them. They drew out money and put it in a life trust account for their 3 kids. And that was their inheritance. So basically, they tapped what they needed to give the inheritance to their children while they were still alive. And at the same time, will continue to reside in the house with no required monthly mortgage payment of principal and interest payments, and can live there for the rest of their life. And if they use up all their equity, they'll just give it back to the bank when they're done. They are not worried about it. They've already withdrawn what they needed and invested what they wanted to do with it.
I'm going to say, wow, again, folks, a lot of great information, some great stories that Karen has. People want to know, I would assume, about fees, about closing costs, how they potentially compare to a traditional forward mortgage or a home equity line of credit.
Sure. So a home equity line of credit is really just in most cases, it's utilized as a second line of credit for people, but it is paid off like a forward mortgage. There's a required payment. There's also full recourse with a home equity line of credit. It also can be terminated at the will of the lender based on adverse market conditions. We'll just say real quick, 2008 experienced that for 3 years. Large lending institutions stopped people's home equity line of credit, shut them down, put a due clause on there, required those payments due and payable right away because of adverse market conditions. That cannot happen in a reverse mortgage. Those are 100% protected from that. But in a home equity line of credit, they are not. So that is, as far as fees go, home equity lines of credit, being in most cases second position loans, are not very expensive to originate. Let's compare the reverse mortgage to an FHA forward mortgage. We do these all the time, particularly for first-time home buyers or people that have high debt-to-income ratios. There's more flexibility in the loan. People that may have had some credit issues in the past, and need some assistance through the government product being an FHA product. So a forward FHA loan, you're going to have escrow, title, and lender fees. You're going to have the same in the reverse mortgage. In fact, the escrow, title, and lender fees are almost very much the same. There's almost very little that separates them whatsoever. Also, in a forward FHA mortgage, you think of your grandson getting himself into his first house. He's going to have an upfront funding fee, just like the reverse mortgage. Now, what the lender gets out of the use of that insurance, like we were talking about the non-recourse piece, that does not happen in the forward FHA space. That borrower is not protected in a forward 30-year fixed FHA mortgage. That insurance policy, that upfront funding fee, really just helps the lender. It defrays costs in case of default. It's to protect the lender's position. It doesn't protect the borrower from a non-recourse action. If the borrower fails to make their payments, lender's still going to seek recourse and come out after them. If the loans are deficient at the upon sale, lender still has the opportunity to seek recourse for the deficiency, where they don't in the reverse mortgage. So they still have that funding fee difference. The reverse mortgage upfront funding fee, the cost for the insurance, is 2% of the market value, where in the forward space, it's 1.75, so 0.25% less of the loan amount. but they still are required to have that. They still also have monthly mortgage insurance premiums. The forward mortgage insurance premium typically is 0.80, 0.85. In the reverse, it's 0.5. It's a lot less. So we get into the cost of the insurance is what most people think and associate, oh, the reverse mortgage is expensive. But they never think the forward FHA mortgage is expensive, yet both of the fees, those upfront funding fees, are wrapped into the loan. Same in the forward space. When a borrower purchases an FHA loan with the house that they're buying in the forward space, that 1.75% is wrapped into the loan amount most often. Very few times do people pay cash for that.
Very interesting. And folks, I mean, this is so much information that Karen's been giving us in the last 30 minutes. As we kind of get ready to wrap up, I do have a question, with interest rates that fluctuate and market values that fluctuate, how does that affect, or does it affect, a reverse mortgage?
It absolutely does. So a reverse mortgage is very strongly based upon market value, interest rates, and the age of the borrower. Those three components are what is calculated in to allow a borrower how much equity is accessible to them. Meaning, you can't just get a reverse mortgage and tap all your equity. And there's a lot of great reasons for that. We want to protect the homeowners. We want to protect the borrowers. This isn't something, when a forward space, somebody can take out, oh my, up to 95% of their market value if they wanted to access it in one way, shape, or form or another. In the reverse space, that doesn't happen. The older the borrower is, and the more equity they have available, the more they'll be able to access. But you take a 62-year-old borrower that has still a mortgage on the property, and they're trying to get it paid down so they could retire, they're not going to have as much accessible equity, cash equity to them as would be the 90-year-old borrower who had their house paid off. So the higher the interest rates go, that affects how much that accessible amount of equity will be for them. Now, you can refinance these loans. You can buy and sell homes using them. And so we look at it the same, similarly, that we do a forward mortgage. If most of us right now are sitting in the 2 and 3% range in a forward space, and those that have been originated in the last 3 years are well over 6.5%. And when the market makes a shift, we'll be refinancing those borrowers down into whatever the current going market rate is at the time, but lower than where they are now. Same for the reverse mortgage. When that happens, those that have gotten a reverse mortgage within the last 3 years, more than likely will go into a refinance situation. Now, why would they do that? So they can access more of their equity. They've also aged, and the rates get lower. They get access to more equity. Then, therefore, they can use it. Now, really key factor I'm going to say here, that upfront funding fee on the reverse side, once it's been paid, you can use a lot of that as a credit going forward in a refinance. It does not have to be entirely wrapped back into a new reverse mortgage in a refi. I just did a woman who had one 11 years ago. Her upfront funding fee would have cost her $9,000. It ended up costing her little under $1,000. It was like $980 because she got to use all of the previous upfront funding fee as a credit going forward into the reverse. Just a little tidbit.
Again, it's kind of stumbling, folks, as I'm just hearing all this information, which is fantastic. You've heard so much information about this product, what a good product it is, the different options you have, and also a lot of folks don't understand, and I think Karen's done a great job of pointing this out. You can use the funds for so many different things, as she's talking about, for retirement, for paying for care, for paying for Johnny or Julie's college,
Age in place.
Yeah, buying a new car, buying a home. There's just so many things that the average individual probably is not thinking about, that you can use the funds from a reverse mortgage. As we do get ready to wrap up, Karen, if people want to get in contact with you, website, email, phone number, what would you like to give out?
Oh, all of it's great. I think the easiest way to reach me is by phone. My phone number is 760-803-2075. I've had the same number for 35 years, so just because I might move around the country, I don't change my phone number. I can also be on, my email address is Karen, Karen, at the Funding Master. It's all one word, all run together, thefundingmaster.com.
Awesome. Again, folks, great product. All the different uses, great information. Pass this on to friends, colleagues, church colleagues, business colleagues, family, etc. And I want to thank you, Karen. This has been excellent. And until we meet again, folks, have yourself an awesome day.